Welcome to the Nichols Tax Update Podcast. This program is made available to you as a member benefit by the South Carolina Association of CPAs. It is produced to provide current information about developments in federal tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. Our first item deals with the recapture of erroneous coronavirus credit refunds. We have temporary regulations and proposed regulations dealing with the recovery by the IRS of erroneous credits claimed from various coronavirus credit programs. The legislation was coming so fast and furious, I frankly lost track of which act it was that gave us which credit or which deduction. But it's pretty well sorted out now, and there are employers who received erroneous coronavirus credit refunds. Those refunds are treated for purposes of collection as the tax against which they were claimed. So that limits the defenses and expedites collection, so the IRS has an expedited process for recovering those erroneous credits. Next, BrokerTec Holdings, Inc., a decision from the Third Circuit. This case originated with a different name in the tax court. Now, the Tax Cuts and Jobs Act changed the law, so no incentives are tax-free after 2017. But because you might be misled into citing the erroneous decision of the tax court as authority without separatizing it and taking it all the way to see how the Third Circuit wound up, the Third Circuit even took it on appeals, I wanted to emphasize that this decision goes against the taxpayer's position. Cash grants by New Jersey to a business relocating to the state were a supplement to income, not a contribution to capital, because the payments were not shown to be part of the company's working capital structure. The Third Circuit interprets the statute the way it's written. But according to the Third Circuit, the way the statute's written, the value of land or other property means other property similar to land. It doesn't mean anything that the state wishes to hand to the relocating business. Now, these returns, the original returns, were 2010, 11, 12, and 13. Some of those returns among your clientele could still be under examination. And I want to make very clear that the Third Circuit has reversed the decision of the tax court regarding the taxability of cash incentive payments. They are taxable. Next, two slides. This is one of two on the IRS's attempt to clarify and regulate our compliance with the business interest expense deduction. We have temporary regulations and proposed regulations not applicable to taxpayers with 26 million or less gross receipts, not applicable to electing real property trades or businesses, electing farming businesses, and regulated public utilities, but applicable to everything else. In tax years beginning after 12/31/2017, business interest expense deductions are limited to the sum of a taxpayer's business interest expense. This is for the taxpayers to whom the law is applicable, and that will be taxpayers with more than 26 million in gross receipts, right? So the taxpayers, the interest deduction is limited to the taxpayer's business interest expense, 30% or 50% if applicable, and if you're working in this area, you know the difference, of the taxpayer's adjusted taxable income and the taxpayer's floor plan financing interest, if any. Continuing from the prior slide, real property trade or business can elect out by agreeing to limit depreciation to the alternative depreciation system or to straight line. Form 8990 is used to calculate and report the current deduction and the amount of business interest expense to carry forward to the following year by any taxpayer to whom this rule applies. Two items of additional guidance are issued at the same time. Notice 2020-59 and frequently asked questions on the aggregation rules for purposes of calculating the limitation on gross receipts. Let's take a look at those two items. First, notice 2020-59 contains a proposed revenue procedure. That revenue procedure provides a safe harbor, allowing taxpayers who are engaged in the trade or business that manages or operates qualified residential living facilities to treat that trade or business as a real property trade or business, which means they can take their interest deduction so long as they limit their depreciation expense. They do not have the 3-point limitation that we saw on slide 1 of this the preceding 2-slide diptych. So the revenue procedure, it gives a safe harbor, allowing taxpayers who are engaged in the residential living facilities to elect out of the limitation on business interest expense by simply agreeing to limit their depreciation to straight line depreciation. Then those taxpayers are not subject to the general rule, but must use the alternate depreciation system, ADS. Some people call it ADS. I prefer to use the full name. Now, next, the issue of the gross receipts test. 11 frequently asked questions regarding the aggregation rules under 448C2 that apply to the Section 163J small business exemption. The frequently asked questions are divided into 3 parts and provide a general overview of the aggregation rules that apply under 1, Section 52A to corporations, Section 52B to partnerships, trusts, estates, corporations, or sole proprietorships, and 3, Section 414M to organizations defined in 414M6A as a corporation, partnership, or other organization. The upshot is that you got 11 frequently asked questions that apply one rule. You will aggregate the gross receipts of all trades or businesses under common control, regardless of the form in which such trade or business is owned. Pretty straightforward rule. If you are required to aggregate gross receipts, or if you're looking to aggregate gross receipts, no, if you're required to aggregate gross receipts so that you're testing whether you're under 26 million or over 26 million, once you're over 26 million, then the law applies to you and your interest deduction is limited. If you're under 26 million, you don't have to worry about the interest expense limitation of Section 163J. I think I got that straight. If I didn't, some of you will send me an email and keep me straight, right? Now, accuracy-related penalties. This is a large business and international division concept unit. It's a 27-page slideshow available to us explaining the accuracy-related penalties. You can use it. You can download it from www.irs.gov. If you can't find it, send me an email. I'll send you a copy. But you can use this for staff training purposes. If you want everyone in your tax department to understand accuracy-related penalties and how to avoid such penalties and how to be forgiven for such footfalls, then you want to use this 27-page slideshow as a staff training tool. In any event, it lists prohibited conduct subject to either the 20% or the 40% penalty. It explains how an underpayment is calculated for penalty purposes. It explains conduct that can result in an accuracy-related penalty as either negligence or disregard of the rules and regulations. And there's a single paragraph that expands on each one of those terms. Then we get an explanation of what is substantial understatement of tax. I don't know what that is there on the bottom. I think that's something that was left over from the transition to the next slide. So let's go to the next slide and see if that's true. Yep, that's the last three letters of penalty on the first line of the next slide. Taxpayer defenses to the assessment of penalty for substantial understatement of tax are also explained as adequate disclosure using a Form 8275, reliance on substantial authority, and for that you want to take a look at Regulation Section 1.6662-4D3, 3i. It tells you exactly what substantial authority is and is not. And then reasonable cause, which requires an explanation of someone's conduct. Other definitions that are necessary if we're really going to study penalties would be a substantial valuation misstatement. What is that? Charitable deduction property, a gross valuation misstatement, substantial overstatements, pension liabilities and/or gift and estate values, and finally, penalties assessed for undisclosed foreign financial assets. A study of the penalty regime and whether or not you can be relieved of penalties is well covered in this 27-page slideshow produced by the Internal Revenue Service to train its own people, but available to us to train our people. Small business accounting methods. This is our last slide, our last content slide in this week. This is a proposed regulation implementing Tax Cuts and Jobs Act changes to Code Sections 263 Cap A, 448, 460, and 471. All of those accounting methods are, the small taxpayer is relieved of using those accounting methods, the small taxpayer being one with average annual gross receipts for the 3 prior tax years of $26 million or less. So most of my clients come under that heading. They have average annual gross receipts of under 26 million. And so we're no longer required to worry about the uniform capitalization rules of 263 Cap A. We don't have to worry about the allocation rules for an acquisition or a liquidation under 448 or an acquisition under 460. Nor are we burdened by the inventory regulations in 471 because we're a small taxpayer. And the cutoff is 26 million for the 3 prior tax years. Keep that in mind as we go about getting ready for the next tax season, as we budget our time and we talk with our clients about the tax budget. That's it for next week. The hourglass is chosen because the days melt as surely as the sand in the hourglass melts, and before you know it, it's next week. So goodbye for this week from the Nichols Tax Consulting Group and the South Carolina Association of CPAs.